This video is going to demonstrate how to prepare a statement of cash flows using the direct method. I have another video in my Accounting is Awesome YouTube channel showing how to prepare a statement of cash flows using the indirect method. Notice the only thing that changes is the operating activity section. The investing and financing sections are calculated the same way. Investing will look primarily at activities that occurred in the property, plant, and equipment area of the balance sheet, and possibly investing section if there is one. Financing section examines long-term liabilities and the equity accounts. So operating activities is the only area that is going to change, and we go at it in a completely different way. Some think in a more direct way. Make sure you list the name of the company, name of the statement. We don't put whether it's direct or indirect. I've only added these notes for those of you who are reviewing the videos. It is for a time period, so this one is going to be for the year ended 2025. So to begin, this is our cash flows from operating activities. We would identify that area. Two sections, how the cash flowed in, how the cash flowed out. So first we'll examine cash inflows from customers. For this problem, that's the only inflow we're going to see. So you go to the income statement, you see sales were $89,000. We're going to assume for this problem that all the sales activities were credit sales and they all flowed through the accounts receivable. The current balance in accounts receivable is $22,000. The balance last year at the end of 2024 was $18,400. So that's a difference of $36,000. That's money we have not received. There is an inverse relationship between the accounts receivable and sales. So we need to take our sales now and subtract that $36,000 we just discovered, we just calculated, and we get $85,400. That's the amount of cash inflows we're going to assume occurred for this problem. $85,400, and there you see it. Now we need to examine each item on the income statement, and we're going to look to the balance sheet to see if there is an account that pairs up to it. So let's start with our suppliers account. To get our amount paid to suppliers of the merchandise we're selling, we need to examine cost of the goods sold. That's going to be our starting point. And then we need to look at changes in the inventory account because that is related to the merchandise we're selling. And then also accounts payable. Do we still owe for some of that merchandise? There are differences here first. So in inventory, the current balance is $25,400. The balance at the end of last year was $20,500. I'm just picking those numbers up. So it increased. We have more merchandise, $4,900. We will add that difference to the cost of the goods sold. So remember that, $4,900. And then we need to look at the accounts payable. So when you go to your accounts payable, the balance currently is $15,300. The balance at the end of the year, $12,100. So a difference, this is an increase also, $3,200. However, this is an inverse relationship with accounts payable. So let's put those numbers up. Beginning with $57,000, the difference between the inventory accounts was a positive $4,900. Direct relationship, so we want to add this amount to the $57,000, and we get $61,900. Now we want to subtract the increase in accounts payable because we owe more. So let's subtract off the difference between the accounts payable balances, and we get $58,700. This is the amount that was paid to suppliers. So let's go back to the income statement. We have advertising expense at $3,200. Now we want to examine any accounts that may be related to advertising on the balance sheet. And so we do have a prepaid account here. So let's look at the difference between those two. The balance now is $10,000. The balance was $8,600. So that's a difference of $1,400. This $1,400 is actually an increase, so more was paid on the prepaid. That's more expended. We want to add it to the $3,200, and we get $4,600. Let's get that recorded. So there we have it, 4,600. Now remember, we are just, right now, all of these are looking like positive numbers, but these are all actually going to be subtractions in the end. This area is going to be employees, so this is going to be for salaries. Let's go back to the income statement. We want to pick up our salary expense, and it is $12,000. Now let's look and see, is there anything related to that, an account that pairs up with that expense on the balance sheet? And so what we're really looking for is a payable, some that maybe have been accrued but not paid yet. We do find that there is a salaries payable here, so let's look at the difference in those numbers. So the balance was $16,400 at the end of the year, and the balance now is $14,000. So we have paid more. We have actually paid $2,400. We want to add to that salary expense, which is $12,000, a total of $14,400 expended for salaries. Let's go back to the operating section using the indirect method. Employees, $14,400. Then we have income tax to contend with. Let's go back to the statement. Let's examine the income statement. Are there any income taxes? Yes, there are. Income tax expense, $2,600. Now let's look and see if there is anything on the balance sheets that are reflected. Here again, we'd be looking for a payable, maybe some taxes that have not been paid yet. Let me clear out that $2,600 so we can calculate the difference here. Current balance is $1,200, so we owe $1,200. This company, Dexter, owes $1,200 in taxes. The balance at the end of last year was $500, so that's a difference of $500. Increase in the amount that we owe, that implies $500 more than last year, has not been paid. So the income tax expense, $2,600, minus the $500 difference, the $500 increase that we found here, gives us $2,100 in income tax expenditures. Add all of these together, suppliers, advertising, employees, income taxes, add them all together, we get a total of $79,800. And again, remember, this is a subtraction from the inflows. These are inflows. Now we are calculating the payments or outflows, disbursements. Subtract that from the inflows. We get net cash provided by the activities of $5,600. If you go out and you review the video that I have for you for indirect, you'll see that it was the same amount, $5,600 for operating activities. Note, this is just for the one section, the operating section. The overall statement, again, the full video and full statement is available for you in a different video, but the overall increase or decrease in cash was the $2,500, and we could have found that check figure by looking at the difference in cash over on the balance sheet. The balance was $9,500. Now it is $12,000. The difference between those two is a positive $2,500. This concludes the operating section of the statement of cash flows using the direct method.